Hi everyone! Stocks closed last week with mixed results. They traded without a clear-cut trend. Their gains and losses were quite small. This is why there could hardly be a trend reversal. The S&P 500 managed to stay at the same levels, although it dropped on Monday. Optimism that prevailed at the end of the first quarter subsided. Market expectations of a policy reversal have changed again. Traders are revising the prospects after analyzing labor market data. Non-farm payrolls data turned out to be not as weak as anticipated. This week they hope to get more clues about the state of the world's largest economy. The US will unveil inflation, retail sales and industrial production reports, as well as producer price and the University of Michigan consumer sentiment indices. The Fed will reveal its meeting minutes. Enjoy our video review and leave your comments down below. It is difficult for investors to make predictions now. Last week, the US ISM Manufacturing Employment Index fell sharply. ADP private payrolls turned out to be significantly less, almost half of what economists had predicted. Job openings for February were downbeat. However, these figures have been quite strong so far. It increased fears of a recession. Data outside the employment sector was also discouraging. For instance, the Consumer Price Index. NFP data surprised investors. Non-farm payrolls reached almost the same level as predicted. Unemployment declined. Traders are puzzled by such mixed reports. Perhaps that's why volatility increased on Monday. Speculators were assessing Friday's reports once again, as markets were closed on the occasion of Good Friday. The employment and wage figures are important as they may provide hints about the Fed's future plans for monetary policy. On the one hand, the NFP report confirmed the expectations that the central bank could raise the key rate by 25 basis points at the May meeting. On the other hand, the data also signaled that the US labor market would be less tight in the future. Hence, traders no longer expect the regulator to end the tightening cycle in May. Prior to the publication of the data, the majority of investors were betting on the end of tightening. Now, almost 66% of speculators are pricing in a 25 basis point rate hike next month. It takes time to analyze a batch of reports, including those published this week. The economic outlook for the US remains cloudy, with almost all macro stats showing that tightening financial conditions are already hurting the economy. The Dow Jones rose by 0.6% last week. The new one began with volatility as investors cautiously awaited inflation data and earnings reports for the last quarter. On the chart, we can see this sideways movement. The question is, what trend will eventually prevail? Economists have polarized opinions. Some believe that nothing prevents Wall Street from moving up. Others do not exclude the possibility of a downward movement. For example, JP Morgan warns about the end of euphoria in the stock market. The current positioning is nothing but calm before the storm. In addition, the banking crisis may have a more long-lasting impact. Stocks may fall to last year's lows due to problems in the banking sector, a sharp rise in oil prices, and a slowdown in economic growth. Fed officials have not announced plans to start lowering rates this year, so traders are making predictions solely on their expectations, not facts. It was the reason for such a strong rally. Now investors believe that the Fed will hardly soften the stance given Friday's strong labor market data. It is bearish for stocks. A week ago, almost 60% of traders were sure about a policy reversal. In other words, the futures markets assumed that the rate would remain at 5% on annual terms. In a short time, there has been a sharp change in sentiment. Now only 30% are still betting on monetary easing. There is still time before the meeting, and opinions may change more than once, depending on the coming data. It means that investors may not need to close long positions. However, they should remain cautious. As for the S&P, it added only 0.1%. It managed to defend the multi-month trend line and the December low around of 3,800 during the recent pullback. However, it failed to reach the expected levels. It was supposed to approach 4,195, 4,270 and 4,320. Nevertheless, the overall movement was rather positive. The index resumed the upward momentum at the end of the week. The S&P consolidated above 4,100. The short-term support level is still located at 3,930. The technical outlook is also encouraging. After Friday's close above 4,100, the bulls may try to test the resistance level of 4,200. The 4,100 level is likely to be in the spotlight in the coming days. However, there is one bearish factor. Friday's macroeconomic data. It may adversely affect the sentiment and the upward movement. An important trading day will be Wednesday, as inflation data will be published. Thus, the index may be volatile. Consumer expectations in the US for the coming year rose to 4.7% in March from 4.2% in February. The indicator has grown for the first time in 5 months as consumers expected higher prices for gasoline, food and rental housing. 3-year outlook for inflation also rose to 2.8% from 2.7%, but the 5-year one sank to 2.5%. At the same time, expectations on the availability of bank loans deteriorated significantly in March. The share of household reporting that has become more difficult to get a loan than a year ago reached a record level. The heavy tech NASDAQ 100 showed the most pronounced dynamic. Last week it climbed by 1.1%, although it tumbled on Monday like other stock indices. Will there be further upward movement? Analysts struggle to give the answer. There are a lot of nuances. Some analysts believe that the rally of tech companies looks weak. The rally that exceeded 20% does not look steady. Tech stocks may return to the lows and even drop further. Demand for tech shares improved amid expectations that problems in the banking sector would force the Fed to end monetary tightening. Investors could be eventually disappointed by their own excessive expectations of policy reversal. Traders bought high-tech stocks during the banking crisis in March and partly as a hedge. In fact, such shares are more pro-cyclical according to JP Morgan. Their bottom coincides with the broader bear market. Excluding the current bearish factors, the trajectory of the index looks promising. It may climb to 13,600. However, it will hardly jump above this level. After that, a downward correction and a new phase of consolidation may take place. If bulls manage to cement the upward movement, the index could advance to the resistance level of 14,270. At the same time, a breakout below the support level of 12,500, which occurred at the start of this week, could signal that the rally was nothing more than a false bullish breakout. We will see a clearer picture after the release of inflation data. As for the earnings season, shares of regional banks fell after the Fed data showed that the total volume of loans from US banks decreased by a record amount of more than $120 billion over the past week. Tesla shares fell by almost 3% after the repeated price cuts for all models. Micron Technology stock jumped by more than 5% after Samsung Electronics said it would reduce their production of memory chips. Banks will publish their profit results this week. Many Wall Street banks are likely to report a decline in quarterly earnings. They could also provide a gloomy outlook for the rest of the year. The banking crisis that happened last month and the slowdown in the economy may affect their profits. Earnings per share of the 6 largest American banks may decrease by about 10% compared to the previous year. JP Morgan is likely to reveal a stronger report as its net interest margin was higher than some of the other banks. The bank is expected to reveal a 30% increase in earnings per share following an increase in net interest income of almost 36%. However, tighter financial conditions and slowing economy could lead to weak credit growth and deteriorating credit conditions. This earnings season will be difficult for banks. Their profits may be affected by another lull in transactions and activity in the capital markets. Some analysts also predict a decline in operating profit. It will deliver a severe blow to investment banking giants such as Goldman Sachs. That is all for now. Hit the subscribe button and keep close tabs on market developments. See you.